Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here today for another episode. And before we jump into everything, as it's finally feeling like summertime here, we got the Bengals schedule has been released. Baseball is in full swing, no pun intended. And just look ready for some pool day, man. I know we got Memorial Day coming up here, and that always kicks it off. School ends, essentially. Yeah, a lot to look forward to here.
Yeah, I also am very excited to get some pool time in. I'm not liking that school's out because all the little neighborhood troublemakers show up for me. So, that's fine. But
Okay, we can get you like a Shepherd Wealth Management paintball gun or something like that,
yeah, I need it. I need something like that because I'm too nice to say anything about it. So,
That's all good. But yeah, a lot to look forward to, and very excited to be here in May, and the half the year's almost over with.
whew, I can't believe
Just a
that.
couple weeks.
Yeah.
Yeah, I feel like we just got done with Christmas.
Yeah.
I'm
I
being
mean, I
honest.
feel like I just was in Hawaii yesterday and it's been a month.
Well, it's been good. It's been really good. And actually, yesterday was a fantastic day for markets. It's always been good to be a Shepherd Wealth Management client, but yesterday was especially good from a one-day performance standpoint. Led us to being able to actually outperform the S&P 500 on a year-to-date perspective, which is always nice. It's something that we pride ourselves on. Performance is obviously a very important and big deal for us and our customers. And last year, we were able to outperform substantially. And so far this year, things are looking really, really good for us to be able to repeat that. Not sure if we'll do it to the same magnitude as we did last year, but obviously we're going to do our very best to make that happen. So yeah, it was a great day yesterday, and I expect more to come. So we'll talk about a little bit that here, why I expect. I'll actually give you guys some very reasons, specific reasons why you should be very optimistic for the rest of the year, even though all the major averages, other than the Russell, are at all-time highs. The Dow Jones is just a tick under 40,000. We're seeing the S&P hit a record high. Same thing for the NASDAQ, and a lot to look forward to here. So I'll get into some of those specific reasons. We'll talk about why we feel that way, provide some historical context around some of this stuff. We'll get into all the economic data that we just received here over the last couple of days. We'll wrap up our thoughts on earnings. So a lot to get to here in this particular podcast today, but I did want to start with questions. So part of the reason, if you're watching the show for the first time, this is really a show for customers and really anybody that wants to learn more about what's going on in the markets, but more specifically, why things are happening the way that they are, and even better, what does history have to say about these events? There's always a historical precedent when it comes to things like the stock market, except for the one time that we shut down the whole global economy due to this thing called COVID-19. So that's the only thing I can point to say there's no precedent for that. But there's always been a precedent for everything else that you're seeing in the news. And I know everybody watches the news because we have these things called smartphones, and it blasts, headline information to us on a regular basis wherever we're at, which is great to be informed. What the news does a very bad job of, in my opinion, is they don't provide a lot of that historical context saying, hey, this is what you should be potentially concerned about because of X, Y, and Z reason. But by the way, there's like 17 other times we've been through something very, very similar to this. And here's what happened for the sectors in the market and the market as a whole over another 6, 9, 12 months. And the reason why the news doesn't do a lot of that is because their real job is to inform you some sort of factual information and then talk about that and what they're going to particularly ask questions around and the things that drive human emotion, because that's what keeps our eyeballs on the screen, right? If we're fearful about something, if we're super excited about something, that generally keeps our attention span a lot longer. That's why they don't give you a lot of that historical context. And if they do, they kind of touch on it very quickly and then kind of press on to whatever other headline news there is. Now, I'm not knocking the news. That's their job. They're there to sell ads. I am pro-capitalism. That's great for them that they're able to make a profit doing that. But what we're here to do on this show is to not just give you, yes, this is what is in the news headlines. Here's why you should, be informed about this information, why it's important. but we do provide that historical context. And the reason why we do all this stuff is because first of all, I'm a human being and I see the headlines and it scares the hell out of me when they, throw out some of the stuff that they do. But when I go back and look what history has to say of their similar events, that's what controls my emotions. It drops my blood pressure down, if you will. Once I understand, what other human beings have done under similar circumstances, because the market's made up of human beings. And unfortunately, human beings haven't changed all that much in a couple thousand years. We're all hardwired with these emotions called fear and greed. And what we've learned from behavioral finance, it teaches us that we feel losses twice as much as we feel good about making a gain. Which is why the news typically is going to ask questions around topics that placate to that fear emotion, because it drives our attention much more than even making a profit. So we're going to provide that historical data here, and it's very, very important. It's what led us to the position that we're in here at Shepherd Wealth Management, starting with June of 21, no customers at all. Proud to say today we're now at 92 million in assets under management, pushing to that magical $100 million number, where we get to be SEC registered. Very excited about that. Hopefully that happens here, maybe even before the end of this quarter of July. End of June here. I'm getting ahead of myself, Des. But yeah, it could happen here this quarter. Certainly hopeful for that. It is a goal for us to do that here before the end of the year, and I'm looking forward to sharing that news with you guys when it actually happens.
Yeah.
So really good stuff. Like I said, I'm excited to be here today. Performance is great, but I did get a good customer question here. I wanted to share it with the audience, some of my thoughts on it before we get into the economic news and some other things that I'm excited to share with the audience here. So I got a question here, and it was from a prospect. By the way, we sit down with every customer at Shepherd Wealth Management on a quarterly basis, and sometimes it's on Zoom, sometimes it's on a phone. Really just depends on customers' schedules more than mine. But the question I got from a prospect meeting while we were out meeting with customers was this. And I was kind of explaining to them, our individual stock approach. We're obviously very big Warren Buffett fans here. I quote him all the time. The topic was around diversification. And the question was, why individual stocks versus ETFs, as an example. For those of you that are not familiar with ETFs, it stands for Exchange Traded Fund. It's a vehicle that's diversified in a whole bunch of individual investments, just like a mutual fund would be. So a basket or a pool of individual stocks, could be bonds. We'll just stick with stocks here, though. So ETF, pool of individual stocks, could be 100, could be less than that, could be a lot more than that. So you're getting that diversification with one investment, just like a mutual fund would be. The difference is you can trade an ETF just like a stock. So it's more liquid from that perspective. So the question was, why use a individual stock approach to building an asset allocation, which is what we do here, versus just using ETFs, which is what a lot of places do. Places I used to work at do it: Fidelity, TD Ameritrade, which is now Schwab, and a whole bunch of other places as well. So there's a mixed bag between all the places that I've worked at and have friends that work at some of these large institutions. And the simple answer is this. I'm taking a direct quote from Warren Buffett here. So Buffett was asked at a shareholder meeting. You can literally YouTube this right now. Go to YouTube and just type in, Warren Buffett thoughts on diversification. It'll pop up. Buffett says this about diversification: is for those who do not know what they're doing, number one. And he said diversification is the death of performance. So let me provide some context here, right? Because it sounds harsh. It sounds like, one, if you're diversified, you might not know anything at all. And number two, you're actually going to hurt your performance, right, as opposed to helping.
Yeah.
So let me
Buffett,
provide
the
some
king of
context.
slams on that.
It's not because he's an older gentleman and he's not a crotchety, if you will. I think he's just speaking some truth to those that are willing to actually get some understanding. So let me provide some of that understanding here today. So first and foremost, I think what everybody needs to understand about performance is, if your benchmark is the S&P 500 as an example. Well, what is the S&P 500? It's made up of 11 individual sectors. We'll talk about those sectors and their performance here in just a second. And all of those sectors have a different weighting. All right, so we talk about weightings quite a bit here. And the biggest weighting in the S&P 500 is technology. So technology is a sector of the S&P 500. The weighting for tech in the S&P is 30%. So in other words, 30% of the stock market is technology companies, right? The second biggest sector is healthcare. Healthcare is 15%, so on and so forth. So the first thing you need to know is what is the sector weighting for all 11 sectors of the S&P 500? Because of this, performance is a calculation. It's a calculation as follows. You take the performance of position one, it could be Apple, it could be Amazon, it could be whatever the position is. So pick your position, call it position one. You take the performance of that and you multiply it by the weighting of that position. So if Apple is Apple is 7% of the S&P 500, right? So if you're overweight Apple, meaning you're going to have a bigger percentage of Apple in your portfolio. So let's just say it's 10%. So you are now overweight Apple by 3% because the market weight is 7 and you have 10%. So you take your 10% weighting in Apple, multiply that by the performance of Apple, and that's a number. You take that number, you add it with the weighting of your position two, whatever that position is, position two weighting multiplied by position two performance, you get a number. You add that to your prior number, so on and so forth. So if you have 60 plus positions, 100 plus positions, which by the way, you're going to have, in an ETF or a mutual fund for that matter, if you're owning hundreds of positions or anything more than 20 is too much for me, and I'll explain why here in just a second. If you own a whole bunch of positions, and let's say in an ETF you have 100 positions, and one of those is NVIDIA, right? And NVIDIA is up, without even looking at it, it's up more close to like 500%, right, over the last couple of years, right? Something staggering. Well, if you have NVIDIA in your account and you have 100 plus positions based on that formula, you're probably only going to have like maybe half of 1%, maybe in NVIDIA, which means even if you get that type of result, which they did, you're not really going to feel that, right, from a performance standpoint, because you own hundreds of other positions and own very little of NVIDIA, even though it did fantastic, right? You're, quote, diversified. Well, all that diversification did was reduce your actual performance for the risk in which you were willing to accept, right? Which is why Buffett talks about diversifications for those who don't know what they're doing. And he's right, because if you're not, if you're too proud or too afraid or whatever your adjective is, some people are too stubborn to want to seek out professional help. It doesn't have to be from a certified financial planner. It could be really anything in life, but we're talking about finances here. So if you don't want to hire somebody like myself to do that, you probably are, way better off just buying an S&P 500 or some sort of indexed ETF and, continue to dollar cost average into that. The problem is that you're going to ride that roller coaster ride of whatever that index is going to do. And for most people, that is too much for them to handle because they feel like all that diversification. If you own the SPY as an example, which is an ETF that tracks the S&P 500, it's very low cost. Another efficient way to go about being an investor. And if you dollar cost average into that over time, you're going to mirror the performance of the overall market essentially, but you're going to have to deal with all those roller coaster rides along the way. Which is very difficult for a lot of people to do because they thought all that diversification was going to protect them on the way down, and it actually didn't because they don't fully understand what they're participating in. So by owning individual stocks, we can actually get the exact same or very similar sorts of standard deviation or volatility, if you will, for our customers. With about 20 stocks, we can get that same level, right? No additional risk per se. But because we're overweighting individual companies, we're actually putting ourselves in a position to outperform the S&P, right? So if we're looking at technology, 30% of the S&P 500, and we believe tech is going to do extremely well for whatever the reason, and we want to overweight that, let's say 50, 60% of our clients' accounts, as long as the tech stocks that we purchased for them or held in their account did well, we're going to outperform the tech sector, if you will. and maybe the whole tech sector is doing better than the S&P like it did last year. That's what gives us an opportunity to outperform. Now, you do have to be right, which is why Buffett said diversification is for those who don't know what they're doing, right? If you don't know what you're doing, you might as well just own all sectors of the S&P. If you're going to try to outperform, if you're going to try to concentrate the portfolio into 20 or less individual positions versus owning all 500 in the S&P, you do have to be right. If you're wrong about the sectors that you chose to overweight, you will for sure 100% of the time underperform, right? You do need to know what you're doing. How we get a grip on what to do is, first of all, look at what history has to say. What have other human beings done in the past under very similar circumstances? Circumstances right now are very low unemployment, which is great, fantastic earnings, and a Fed that's looking for a reason to cut interest rates, right? There's a precedent for that. We're going to talk about some of that here in just a little bit. And what actually happened in the market over those circumstances. And add on, okay, this is an election year as well. There's so many different things that we can throw on our research and get a really good understanding about how human beings have behaved in this very, very similar environment. Because I know human beings haven't changed all that much, now I'm at least putting the probabilities in my favor when I go to overweight something or choose to underweight a sector of the market. It's for that specific reasoning. And of course, what individual companies to own, well, that's going to come down to, okay, I've already done my research. I understand maybe that tech's going to do great here under these circumstances. What tech companies should I own, and how much of them do I want to own? Well, that's going to come down to, the individual research in the company and their board of directors and CEO, right? The fundamentals, all the technical analysis, plays a part in all of this as well. So it's not just what does history have to say. It's just the starting point to calm down your emotions so you can think logically and make some intelligent decisions and put those probabilities in your favor, but understanding what history has to say in the environment that we're now investing in. That's the reason why we use individual stocks. We'll throw in some ETFs too. We definitely do a little bit of that here for our customers at Shepherd Wealth Management, but it's pretty few and far in between. And it's for a very, very specific reason. So as of right now, there are 2 ETF holdings in our customer accounts. One of them is a long-term U.S. Treasury ETF with a duration of 20 years. We're buying that for growth though, right? We're expecting rates to come down. Again, we have a Fed that's looking for a reason to cut interest rates. They've finally gotten some indication that, rate cut might actually happen here. We'll talk about what that is here in just a little bit. But yeah, so there's a precedent for a lot of this stuff. That's why we do this show, is to let you guys understand what the information is, what does history have to say about it, what are the probabilities of success under these circumstances, and now we can start to make some really practical decisions that might actually, if you're a growth investor looking to outperform, gives you a chance of actually doing that. So that's the reason why we use individual equities over ETFs, but we do sprinkle them in there here and there for very, very specific reasons. Like I said, that 20-year Treasury ETF. Why do we do that? Again, ETFs can be traded just like a stock. As interest rates come down, as we expect them to, the long-term Treasury duration value actually goes up. So there's an inverse relationship between interest rates and bonds. Again, as interest rates come down, long-term bond value actually increases. And that's why we have it in the account, so I can sell it stock within a tenth of a second when we're ready to exit the position. But I'm also getting exposure to those 20-year treasuries without actually going to buy and holding, a 20-year treasury. It's much more difficult to actually sell an individual treasury as opposed to just selling an ETF that owns the 20-year treasuries. So we do it for specific reasons like that. And I thought it was a very simple question from a customer that probably is in the minds of a lot of the listeners here. So I wanted to share that with the audience. So if we don't have any other topical questions from customers, which I think that was the main one, is
nothing's come through yet. So
yeah,
good.
We'll dive into some of the data that we got here. So we got some economic data, producer price index. We got that on Tuesday, May 14th, just a couple days ago. That actually came in hotter than expected. So the news came out at 8:30 in the morning, as a lot of this economic news typically does. And futures dropped immediately, but they rebounded and actually was a pretty decent day on that Tuesday for the overall markets and the sectors. mostly due to the fact that the producer price index for the prior month was revised from a positive number to a negative number, which means the producer price index on an inflation standpoint, the wholesale index of inflation, that's what this is, was actually negative last month. So there was a revision to that. And once that news came out, that obviously changed the tune of how individual investors felt about the producer price index. But the big one was yesterday. CPI, your headline inflation number, came in a little lighter than last month. So last month it was 0.4. This month it was 0.3. So lighter is good. CPI year over year came in line with expectations. So that's also good. Same can be said for core CPI, came in line with expectations. So really good information there. And it gives the Fed at least one data point that's falling back in line with what they were expecting to have happen here. So the first part of the year, all the concern was inflation's going in the opposite direction. You're seeing spikes in inflation. We talked about why that was. It was really some seasonalities in the data, and in addition to that, we're seeing some outsized inflation for things like auto insurance. We talked about why that is. Really quickly, auto insurance premiums went up due to the fact that used car prices, new cars prices went up during the pandemic, and now auto insurance companies are finally catching up with this increase in auto prices. As you can imagine, vehicles being more expensive when they break down or have to be repaired. The parts are more expensive, the labor is more expensive, shipping all that parts is more expensive. Therefore, auto insurance companies have to increase premiums. They're catching up with that right now, and it's a state by state thing. This is why you're seeing a lingering effect with auto insurance inflation. But that actually changed here in this CPI print. As I mentioned, we saw CPI month over month come down from 0.4 to 0.3, which is really, really good. And the main reason for that had everything to do with auto insurance, actually. And auto insurance for the prior 3 months of the year, so this would be January, February, and March, came in at 0.4. And this last report that we got for CPI, auto insurance component of CPI, came in at 0.1. So that's a huge deceleration from what we've seen in the prior months. We talked about why that was in a prior podcast. If you missed that, I'm not going to spend time talking about it now. Just go to shepherdwm.com, our website. Right at the top of the page, it'll take you right to our YouTube channel, Spotify, and you can also check it out in our newsletters because we wrote about this as well. All that information can be found right online. So does the producer price index and the headline CPI index, is that going to sync up? Again, we saw a negative revised number for PPI, and CPI is now coming back in better balance of what the Fed was expecting inflation to do this year. I think the answer to the question is, does the producer price index, that wholesale inflation number, and CPI, which is consumer index, does that have to sync up? I think the answer is yes, and it takes some time for it to do that. We talked about in prior shows, why that is. It has a lot to do with housing and auto insurance. That makes up, call it roughly approximately 45% of the CPI calculation. And all the other stuff, that other 55% is actually trending below its 20-year average, falling well below the 2% number that the Fed's looking for. So you're seeing CPI headline being propped up by auto insurance, inflation, and housing. And I just mentioned how auto insurance is now trending and drifting lower. I expect that to continue because you are seeing car prices come down a little bit as well. Housing is just taking freaking forever for that to actually start to show up in the data. But if the Fed were to not look at backward-looking data like it does from a housing perspective, and you look at forward-looking data, it's very clear why the Fed is actually looking for a reason to cut interest rates. They know that housing is coming down. They know that auto insurance is coming down as well. So a lot to look forward to on the inflation front for the rest of the year. And that's the baseline case for why people should be optimistic. And I'll spend a little bit of time talking about more specifically why that is here in just a second.
That housing lag, we're going to remember that for years. It's like the Jabberwocky lag we just can't get rid of.
Man, it's brutal. It's like molasses, it's just extremely slow and actually showing up in the data here. But eventually it will sync up, and that's going to be a really, really good thing for markets, no question about it. Now, in 2024, just to remind everybody, kind of set the stage here a little bit before we get into reasons for optimism. So in 2024, the CPI reports we've received, 4 of them this far, have actually had an opposite effect on Fed rate cut expectations. So when we got to January this year, markets were pricing in almost 7 rate cuts. Then we had the CPI. The December CPI was released in January, and that number dropped to 5. Right. Then we got the January CPI a month later. That number went from 4 rate cuts down to 3. Right, and that's where myself at Shepherd Wealth Management got a little nervous. Right, when we went from 7 rate cuts down to 3 in just 1 month, that to me was an indication that the market may have mispriced equities, and I was expecting some sort of sell-off. So we raised a significant percentage of cash, way more than we would ever normally feel comfortable with. It was because of that right there. And actually, nothing actually happened. But then we continue to press on. So we get into February, getting January's inflation print. Again, it came in hotter than anticipated. So now we're looking at 2 rate cuts. We get the March CPI print, and rate cut expectations have actually dropped to 1. As we got the news yesterday for CPI, it went from 1 to a little over 2. So markets are now pricing in, let's call it 2.5 rate cuts throughout the remainder of 2024. And as markets anticipate a rate cut, obviously markets from a stock price perspective, get pretty excited about that, which is why you saw an excellent day in the stock market yesterday. I think it was roughly 2% on the NASDAQ. S&P had a stellar day as well, and we did quite a bit better than that here at Shepherd Wealth Management for our customers. In anticipation of that, we've been talking about anticipating rate cuts all year long and positioning yourself accordingly. And we provided a ton of reasons why you would want to do that, and specifically small caps. The small caps, from a historical perspective, have outperformed large caps when we do get that first rate cut. Now, we didn't get the rate cut yesterday, but small caps is one of the better performing sectors because the market is now pricing in an additional rate cut and a half from where it was just a couple of days ago before we got the latest CPI print. Therefore, your portfolio from an asset allocation perspective should start with this. What is the weighting of all the S&P 500 sectors? And then what does history have to say about the performance of those sectors over a 6, 9, 12-month basis, or even longer, if you want to go longer? What does history have to say about the performance of those when we have a low unemployment rate, really strong earnings, and a Fed that's looking for a reason to cut interest rates? Like, they want to cut rates, right? They definitely do. So what would typically do really well? Well, small caps historically outperform large caps when we do get that first rate cut. We haven't had it yet, which is why the Russell 2000 is only up a little more than 4% year to date, whereas the S&P 500 is up approximately 11% year to date, is because we are now getting a little bit closer to that potential first rate cut. So even though small caps have lagged, if you've been dollar cost averaging into that all year long, when you do eventually see that rate cut, I think you see a significant spike in small caps. A lot of ways to play that. We're actually choosing to play that with an ETF, and the ETF that we're using is the Russell 2000 IWM. You can choose how much you choose to weight in that, but if we look at what history had to say about small caps under similar events, you can go back to 1999 through 2011. That 12-year stretch, small caps outperformed the S&P 500 on average by 6% every year. The cumulative outperformance over that 12-year period of time for small caps was 113% better than the S&P. And that's the last time you've seen small caps go through a stretch like that. Now, what happened in 99? We had a very strong economy, strong earnings, strong growth, low unemployment. Fed wasn't looking for a reason to cut interest rates, or basically trying to make sure the economy didn't get too hot. And then all of a sudden we had the dot-com bubble burst the very next year in 2000 and bled into 2001 with all these internet stocks. So the internet's finally a thing. It kind of blew up overnight. And if you had .com next to your name as a publicly traded company, your stock price went up just because of all that enthusiasm. And once everybody realized that, most of those companies actually don't have any sales or revenue or anything, markets fell out, from a valuation standpoint. A lot of people got hurt big time during all of that. Now, What's the difference this time? We have a similar unemployment rate. We have a very, very similar type of growth prospects from a GDP perspective. Um, the corporate earnings are nothing but fantastic. The difference this time is artificial intelligence is not what the internet was back in 1999, 2000. Artificial intelligence is actually a real thing that's showing up in real earnings right now, and it's starting to accelerate potential earnings growth for corporations. That's where the enthusiasm is similar, but very, very different. We're actually seeing sales and impacting corporate earnings right now at the very beginning stages of AI. The only difference is now the Fed is actually looking for a reason to cut interest rates. So all that being said, small caps should significantly outperform. And if we get anything like what we got from that stretch from 1999 to 2011, I wouldn't be surprised if you saw small caps, significantly outperform in a way like 50%. Not saying that that's going to happen between now and the end of the year for small caps, but you could actually see that happen. And if that did happen, by the way, small caps from a valuation perspective would actually be in line with where large caps are at right now from a PE perspective. It's very, very similar. So there's very real reasons to actually look at small caps and get pretty excited about that. And of course, when we get to things like technology, of course, tech stocks do really well in an interest rate cutting environment, but tech is not leading the way thus far this year. So of the 11 sectors in the S&P from a year-to-date perspective, technology is only up a little more than 2%, whereas energy is up 12.5 year-to-date. Energy is one of the smallest sectors of the S&P 500. Industrials are actually doing better than tech. Industrials have been a big play for us. And if you've been a fan of the show and watching it, you would understand why that is. Very, very specific historical reasons why we really like industrials. But industrials are up 7% year-to-date. Communication services up 7.5. So there's a lot of things within the S&P that have actually done better than technology. But essentially, everything is positive on all 11 sectors except for real estate, which is kind of obvious with where interest rates are at. But there is a real estate play at hand here for those that are following along with our show. We're positioning customers in the things that are interest rate sensitive because we know the Fed's looking to cut. Well, there's a $5 million housing or a 5 million home shortage here in the United States. That's not going to get solved with the first rate cut. It's going to take quite a while for that to that supply to actually meet up with demand here from a house building perspective in this country. So there's a lot of optimism for the real estate market if you are a longer term investor and you can deal with some of the shorter term volatility. But real estate is really the only sector of the S&P that's negative year to date. I do expect tech to probably be right behind small caps as we do get into an interest rate cutting cycle here by the Fed coming up. And that's also really good for things like crypto. So we're not Bitcoin holders here by any means, but you can use some of the miners. That's exactly what we're using for our customers as a way to get access to that asset class without directly owning it. And there's from a investing standpoint, our biggest sector weighting is certainly tech, and right behind that is going to be small caps. We're looking at home builders right now. Home builders had a great day yesterday as a whole sector. Was up more than 3%, way better than the overall market. So those are things that we're looking into as well. But the main holdings for us certainly are going to be small caps, tech, and industrials, with a tiny little bit of crypto in there from a miner perspective. So that's actually done fantastic yesterday, that position. I won't drop the name on it. You can catch other videos that we've done here, and I've dropped it. But it was up 15% yesterday on the heels of the CPI data. So really, really strong stuff. Now, want to get into earnings just a little bit here because we're wrapping up earnings season. Pulling up the data for that is, give me 1 second. And from an earnings perspective, we've gotten through 92% of the S&P 500. That's 462 companies. Believe it or not, there's only 7 companies reporting this week. But of the 92% of the S&P that have reported, 81% are beating their estimates, and those that have been beating by a median of 8%.
Wow.
The primary reason for that, if you're wondering why that is, well, we had jobless claims news today, and that came in line essentially with expectations. Market was looking for 221,000 initial jobless claims. 222 was the number, and that dropped from last month. It was 232,000. So when consumers have a job, I don't know if a lot of people know this or not, but 70% of the S&P 500 is made up of consumption, people buying stuff. So as long as people have income, they're going to buy stuff, which is a big reason why corporate earnings are stellar and actually rising, which ultimately helps GDP. So again, folks, I don't know why. Well, I think I do know why. It has everything to do with human emotion, and people looking too much at the headline and not actually looking at what history has to say, like we've been preaching here all year long. And I'm not going to do a victory lap. This is not the victory lap show. We talked about that before this. We're finally outperforming the S&P again this year. We beat it to death last year, and I wanted to do a big "I told you so" kind of podcast. Well, I'm going to save that to sometime in December. It'd be way too premature to call it victory here, as we're in the middle of May.
Yeah.
But
especially you were calling for most of the performance to happen in the back end of the year too, so you don't want to leave that out of it,
That's true. I did say that. Said that in January. I still stand by that because I think we're going to see at least a couple of rate cuts before the end of this year, maybe 3, but I'm going to stick with at least a couple for now. All of which is good for what we're positioned for here. No question about it. So we'll save the victory lap for sometime later this year, in December, appropriately. But we've been calling for it, expecting this all year long, and we still see $6 trillion sitting in cash. I don't know what it's going to take, but that hasn't even started to trickle into the market. Like, people are top calling here because the S&P and the NASDAQ and all this stuff is at all-time highs. I don't think anybody is looking at what history has to say, because when you see a sector, a stock, the overall S&P, anything hit a new all-time high, well, if anybody's ever heard of technical analysis, you hear about support lines and resistance lines. Well, now there's no resistance, right? So it's going to continue to find some sort of resistance, but it doesn't just, boom, hit an all-time high by 1 penny and then immediately come down. Like, that's just not how things work, right? When things build momentum, it's going to continue to build upon itself until it gets too exuberant. And that's where you see, maybe some consolidation for a stock. And that doesn't even mean it's hit an all-time high. Go look at NVIDIA. Everybody thought NVIDIA last year, when it went from like $300 to $500, the PE actually got less expensive because of their future prospects for sales and the earnings that can come along with that. But everybody was top calling NVIDIA, and now NVIDIA is over 900. It's going to probably break through 1,000 here once we get to their earnings here. I think it's on the 26th, 23rd or 26th, something like that, coming up at the end of the month here in May. So I'm very excited about that. If you're looking at a chart and you see a new all-time high, that generally means there's probably some more room to go there. Now, again, do your homework. I'm not giving anybody individual recommendations on any shares of stock. I know we do that for customers for obvious reasons. But when you see the market hit all-time highs and you see $6 trillion still sitting in cash, it's like, what the hell was everybody sitting here doing? Like, what are you guys waiting for? I can't wait for you to participate, because things are already so damn good. By the time you guys put your money in there, it's going to make things look even better for us, and you're going to catch the little tail end of performance. I'm sorry, but unless you guys start to look at what history has to say, I think you would change your perspective on where your cash should probably be sitting. And some of that could be for, obviously, planning purposes. People do need cash. I'm not saying don't have cash. But for those of you out there that are still waiting for the market to fall and find a better entry point, you're going to be waiting for quite a while. So that the whole adage of time in the market is much better and smarter than timing the market is very real. You could Google, if you miss the best 10 market days in the last 30 years, you'll be staggered as to the difference in your performance. I think it's 40% less or something in that ballpark, approximately, that you would have if you missed just the best 10 days in the stock market over the last 30 years. You have to be a participant. And if you don't know what you're doing, listen to the wisdom of Warren Buffett. Either buy the index, dollar cost average into it. Don't watch any news. Understand that you're going to deal with all the volatility that comes along with buying an index, and that you're never going to be able to outperform because you're buying the index. But you're not going to outperform the index if you just own the index. You have to accept all that, or you could reach out to somebody like myself, 513-630-2664, and we'll show you the way. We'll show you how we do things here at Shepherd Wealth Management, and to get the types of results that we have been able to get for our customers, and wrap that around with unmatched service. So for those households with $500,000 or greater, we actually work with CPAs to prepare and file our customers' taxes at no additional cost. Do the same thing on the estate planning side for those households. If they have to update a will or trust, we work with certified estate planning attorneys, or work with directly your attorney if you choose to do that, and we'll provide up to $1,500 credit to cover those costs to make sure that everything is in line with the investing, the estate plan, and from a tax perspective. And plus, we do a lot more. Like we do this show every couple weeks. At least we try to do it every 2 weeks. And then, of course, we send out a weekly blog, which we usually post on our website. You can find that there at shepherdwm.com, as well as a monthly newsletter. We push almost all of this content through our customers' mobile app, which is free at any app store. But if you're watching the show and you want the app, it's not going to do you any good because unless you're a Shepherd Wealth Management client, it's just not going to be active for you. So just want to put that out there for all of you that might want to try to download that and then send me a question later. You're not a client, it's not going to work. So we can just get that out of the way right now. So we gave some reasons for optimism. I want to make sure that I covered all that as before we wrap it up. Yeah, I think we did. Yeah, so let me just rattle off a couple of reasons here. So we definitely are surprised by how bearish a lot of people are. Historically, that's a really good thing. If you see a whole bunch of people sitting in cash, that's usually a pretty good indication that it's probably not a bad idea to be in the market. Buffett famously said he wants to be greedy when others are fearful, and then he wants to be fearful when others are greedy. So now would be a good time. If you're still not participating or haven't fully participated, might want to do so. We're seeing interest rates and the VIX, the volatility index, starting to fall. Again, the Fed is dovish, $6 trillion of cash on the sidelines. Talked about that. And the stuff that we like, the very best under this environment, Fed looking to cut, strong GDP, strong earnings, low unemployment. We're definitely going to be overweighting technology. We might continue to add to that sector. If you're investing in healthcare, healthcare is the second biggest sector of the S&P. We have a small weighting in healthcare. We're still underweighted for sure. Some of those Ozempic names, Eli Lilly, is an easy one to point out to. That's probably going to continue to work. Financials and industrials. So financials, interest rates coming down, loan demand generally goes up. That's how banking institutions make a profit. From the industrial standpoint, there's two main reasons why you want to consider that as a overweight in your portfolio. Main reason, or a couple reasons primarily, is interest rates coming down. It's a good thing for manufacturers, makes the cost of capital funding their operations easier. And the federal government's already going to be spending trillions of dollars on infrastructure, EV batteries, chip factories, etc. All those industrials will work well. And from a historical standpoint, that PMI index being below 50 and then trending upwards like it has here the last couple of readings, historically over a 6-month time frame under those circumstances, you're seeing the average industrial performance be about 12%. A 12-month forward return for industrials under those circumstances historically has been about 22%. So those are averages. Doesn't mean it's going to happen. It could be better or worse than that. But we like the sector. I would consider it an overweight. And of course, we talked about the small caps potentially being a huge outperformer. And then lastly, I think it does make some sense in an interest rate cutting cycle to add some more beta to the portfolio. Beta is just a statistical measure of how closely does that position track the performance of the S&P. Well, you're going to have a huge beta for something like cryptocurrency, meaning that the Crypto typically does a lot better than the S&P on an up day in an interest rate cutting cycle, which is why we're into that in a smaller way than a lot of people, but it is working out well. So those are the things that we're excited about, and those are the reasons why we're very excited about it. A lot of it has to do with some historical information. Some of it has to do with just some common sense. Blend it all together here at Shepherd Wealth Management, and what you actually end up with, at least so far, is some outperformance versus the S&P 500. So happy hunting to those out there that are still hunting for positions to add to their portfolio. Hopefully this was helpful. And it's definitely working for us here, and certainly hope it works for you. If you got questions, we love to hear them. You can send it directly to us. I think they can ask questions right in the chat right here on YouTube. Is that right, Ez?
Oh yeah, chat's always open, as are comments. So if you drop a question and a comment on a video, previous episode, little clip, something like that, we'll make sure that it gets to Joshua and gets answered in the next installment of the podcast, next episode.
Yeah, and I got a quick bulletin here. Fun fact, it took 873 days for the Dow to climb from the 30,000 level to the 40,000 level. Pretty cool.
That is
I don't know how many years.
less than I expected, but yeah, that's very cool.
Yeah, so a little fun fact there to end the show. A lot of fun. We'll do this again in a couple of weeks, and that'll put us right in June. So like I said, half the year will be gone, but we'll have a lot more to share with everybody. From a macroeconomic standpoint, we'll get a whole bunch of more news. We'll be out of earnings season, and some will officially have kicked off. So we're definitely looking forward to doing this in a couple of weeks. Please send the questions, and I look forward to answering them on the next show. Hope you guys have a great rest of your day.